amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with a steward's view. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. With your host, Aaron Kolkman, managing partner of Fideer Advisors in Minneapolis. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time with a steward's view. A Steward's View is brought to you by Fideer Advisors, a registered investment advisor. You can listen to this podcast and previous episodes at fideradvice.com. That's FIDERE advice.com. Now here's your host, the managing partner of Fideer Advisors, Aaron Kolkman.
Welcome back to A Steward's View. I'm Aaron Kolkman. So glad you chose to join us again. Please do check us out online at fideradvice.com/podcast or go to Apple, Spotify, SoundCloud, even YouTube, and follow us there. You can like, listen, and share on any of those platforms. For today, I'd like to talk a little bit about what's been going on with the tariff picture, with the economic changes that are happening around trade, and in particular, ways for investors to consider it as they navigate their own next steps. So let me say this. Stocks are a leading indicator of economic activity. Corrections and bear markets are normally very short-lived. Investors collect handsomely in the months following the entry of small cap and tech stock indexes after they come into that correction or bear territory and then come back out very quickly. Large companies, those indexes are less volatile, but they're no different. So investors do really well right on the heels of these moves downward. And you've heard me talk in previous programs about the caution around going to cash just as a tactic and then trying to get back in, or perhaps adding cash even at the wrong time or rebalancing at the wrong time. And we'll talk a little bit more about that in this particular program. But I just want to impress upon our listeners that in the months following correction, bear, those kinds of moves in markets where we've got 10 or 20% down respectively in major indexes, whatever you're using, as your index, your thermometer, as I call it, the months that follow those moves are incredibly profitable for investors. So much so that you really don't want to be uninvested and miss it. Further, I want to talk a little bit about the dollar. Okay, we've talked about dollar policy. We've talked about how the position of this current Treasury chief, or his posture, is to have a strong dollar policy. Okay. I'm not sure that that's very clear to many listeners. So I want to just say this. A strong dollar means that the real value of financial assets denominated in U.S. dollars gets maintained. Okay? So likewise, a weak dollar would mean that the real value of financial assets denominated in dollars does not get maintained. Okay? It sounds simple enough, but let's play it out for a minute. So if I have a portfolio of stocks and bonds that we talk about a lot in this program, and I'm working on funding my goals with that portfolio, and I'm looking at the value of that portfolio. What happens when the dollar isn't strong, however we define that? Does the price of what I own in my portfolio change? Did the markets that I'm invested in go up or down any more or less? No. That's the confusing thing about what we enter into when we talk about the dollar. Now, the dollar globally is a reserve currency for the world, right? That speaks volumes about the view of the U.S. and its economy in terms of the way that the currency markets interact and the way that this plays out for investors, okay? And I'll say it again. if we have a strong dollar, we don't then get concerned about the dollar-denominated holdings in our portfolio being worth in actual or real terms any less than your statement actually shows or your login actually shows, right? We don't have a strong dollar. For example, this year we're down 6%. This was as of April 6th when I wrote this out on A Steward's View. That's, let's see, to be clear, fidureadvice.com. In the footer, there's a connection to our white paper series, A Steward's View white paper. You can pick it up there. I think it's also on our homepage right now. But this year, as of April 6th, the dollar was down 6%. Okay. So does that undercut the value of what you see when you log in or when you open your statement? Yes, it does. Right? So the real value of what I own is less by the amount that the dollar is down compared to what? Compared to other currencies. Okay. Well, my comment, this phantom devaluation, as I call it, is not a primary concern. Why not? Well, one, financial markets come back very quickly, as we just mentioned, right? But two, and there's some conjecture here. I mean, I don't anticipate the dollar continuing on this trajectory. This was a very tumultuous time in the second half of the first quarter, and then this first few days of April, as we saw the tariff picture, you know, and the stage that we're at in that negotiation of tariffs and the trade stuff, all of that come to pass, that affected currency markets greatly, right? So, we just need to be aware of it, not to treat it as a primary concern, right? I've said many times, this is not a trading program, so we're not going to go into, currency plays and those things. We are going to say, let's just be aware. Let's just know that, okay, there's a strong dollar policy in effect. We're going to try to consider if there are continued moves downward in the value of the dollar, that, it does have an effect on us. Not in what we read when we log in or open our statement, but it does in terms of our the real value of what we're holding. Okay, so that's different than inflation. Inflation is a more clear change in prices around us of what it costs to buy something, a good or a service. And so that's a different way that your buck, so to speak, is worth less than it was before. Okay, so I want to distinguish between those two also. Okay, but let me just say this. Treasury Secretary Bissett made a comment on, I believe, April 4th, but he said that 2025, and I'm summarizing, 2025 repricing of the dollar, or the change in the dollar in 2025, is a welcome dynamic in order to force other countries out of currency manipulations. Okay, so that dives pretty deep into the interplay between our currency in the U.S. and other currencies abroad and how they interact in the marketplace. But suffice it to say that we have, in fact, been taken advantage of in the currency markets. We do have other countries that for a very long time have fixed their currency prices based on the strength of the dollar. And so to see that come undone may sound negative, like, the dollar's worth less. Well, yeah, but there's repricing going on globally here, right? And so the lower ability or the lesser ability of those foreign currencies to be, fixing themselves or manipulating currency markets in their own favor is actually a very good thing. So I'll leave it there, but I want to make sure that I say out loud, we do have a little bit of a drop, a noticeable one. I don't want to minimize 6%, but I really don't expect a lot more of that. What I do expect is that we'll see a stabilization of the dollar here, and just let's have an awareness of how that comes in. But let me summarize what's happened, because we've talked a little bit about currencies, we've talked about market activity, we've talked a lot about the economic backdrop, and I just said that stocks are a leading indicator. On the whole, these economic shifts we've seen just recently, just in March and April 2025, and the resulting market changes means very short-lived pain for investors. I want to say that again. This should equal short-lived pain for you. Markets have already priced in a new set of investor expectations. So reallocating long-term capital should be avoided wherever possible. What do I mean? To say, well, I'm going to suddenly change my investment strategy in the middle of all of this chaos, it's not a very good idea. It's something to be careful of, avoid if you can. But preparing to deploy new cash and rebalance existing strategy that you have, rebalance, what does that mean? Take whatever did the poorest and reinvest in what did less poor. Because right now there isn't a whole lot doing great, at least in stock terms, right? In bond terms, things have been changing rapidly, and there is some price increasing going on in long-term bonds. That's the 10-year treasury that we talk about, the yield. We haven't said prices are up, and that's why the yield is down. But there's a lot of rebalancing there that can happen as well. What do I mean? Well, we'd sell the bond holdings that are up in price, and we reinvest in the stock holdings that are down in price, especially those that are down the most. Okay, so that's what rebalancing does. It's a reset of my overall investment plan. And I argue that that should be across accounts, all accounts in one investment plan. Why? Because it's most efficient, it's most productive. Okay, so what then? Thinking about any new cash, anything you're going to bring in, positioning that cash, getting ready with that cash, taking existing holdings that are already invested with a current investment plan, getting ready to rebalance, and then doing that into the hardest hit areas of the global market. Those are the prudent moves. That's how to capture opportunities in the current environment. It's not to try to play this, to try to game this, to try to get fancy, or to change things fundamentally that you're doing. It's just a simple, get ready to rebalance, get ready to add cash. Okay. Well, when the time comes, it mentioned back in March the 10th, what it looks like to rebalance. And that particular program was about the high volatility that we've had. But whether or not we have high volatility, whether or not we have this chaos, the same pattern and the same reinvestment, I hate to use the word timing, but the effort to find a return, a returning to normal prices off of a relative bottom, that conversation, that's exactly what applies here too, right? So we've seen these now larger moves down in stock indexes. Okay, so I'm really glad we had that conversation back on March 10th, to where we can say, all right, I'm going to bring my cash, I'm going to bring my, my expectations of what I'm doing with my long-term investment plan, and get ready to rebalance that and maybe add that cash. When I'm convinced that we've come off of a bottom, or a relative bottom, right? And no, it's not guaranteed, but it is possible to know something about what that looks like. Okay, we have a bunch of bullish signals we could go into. The one I use is taking the S&P 500, looking at volume, looking at buyers versus sellers, looking at the number of days in a row that we have increasing volume and buyers outpacing sellers on the tails of major moves down like we've had. So when is that? Impossible to say if that's days or weeks. I've seen it take months. But back to the original comments in this particular program, what goes on in terms of downside and moves into correction and bears is very, very rapid coming back up. And I do expect in this particular case this year that what we're seeing right now is going to be extremely short-lived. Okay, so whether or not we have a recession, we'll talk about that in the second segment. I want to emphasize that now is the time to be getting ready in this way.
More of a steward's view in just a moment. Investors have stocks, bonds, mutual funds, ETFs, options, futures, real estate, and more. There's one place to look at all of your portfolio. It's called Fusion. Portfolio aggregation. No contract, no hassles. Fidere's portfolio technology gives its users a chance to see all of their assets all the time, wherever they are. The Fusion platform is open for use without a contract and without a hitch. It's based on mean variance optimization and analysis research by Aaron Kolkman. Fidere uses the Fusion platform to optimize assets for its clients. For more information, visit fidereadvice.com and click on Fusion at the top of the page. That's Fidere Advice, FIDERE EREadvice.com. Now back to A Steward's View with your host, Aaron Kolkman.
And we're back in the second half. Thank you again for joining us on A Steward's View. I'm Aaron Kolkman. I'd like to talk a little bit about the R word in this segment. So there's much said about the question of, will we end up in a recession this year, particularly on the heels of the tariff announcements last week or April 2nd. Whether we do or don't is certainly not clear. The consensus appears to be that we'll have either a mild recession or none at all. And those are major brokerages that are coming in with their analysts, weighing in different corners of the market and looking at things saying, well, looks like little or nothing in the recession department. Okay. Even if we have a more severe recession, which I'm not suggesting, we talked in the first segment about stocks being a leading indicator of economic activity. Okay, so what happens when we say, well, stocks are, and this is just based on my own experience, I'm sure that there are some market technicians that could clarify this further. But if you say, well, stocks are moving ahead of what the overall economy is doing, okay, that's months. Is it 2 months or 6 months? Yes, it varies, right? The comeback of stocks off of a bottom, I just said in the first segment, I expect that this comeback will be very fast, not COVID fast, not March 2020 to April 2020, but it will be fast. That's my expectation. Okay. Well, if stocks come back, and let's say hypothetically they come back during the month of April, and you open your statement, and I'll talk to Chaz here. Chaz, you open your statement, and it's now
my Fidelity account or whatever?
Sure. You open that at the end of June.
Mm-hmm.
Okay. And then you do it again at the end. Well, I'm sorry. You probably opened it in July, right?
Okay, yeah.
And maybe opened it again in October and then in January. Okay. So stocks, we're in correction and in some cases bear market territory right now. Okay. Here we are, April. This is being recorded April 7th. But you're opening these statements in July and October and January, or maybe you're logging in between those times.
Mm-hmm.
Okay. And you're kind of checking things out. All right. Well, however you do it, however you follow what's going on with your holdings, you have this experience over the next 2-3 quarters of growing assets or rising asset prices,
Mm-hmm.
right? After April. And I'm not guaranteeing it's April, but I'm supposing that it probably will be. So does it matter to you? And I'm asking this now. Does it matter to you if by the time we get to the end of this year and you've had growth in your portfolio, new growth, okay, whatever that looks like,
Mm-hmm.
assuming we get it, does it matter to you if the U.S. economy was slightly negative for 2 quarters during the year?
But yeah, I would like to see our country do well because I'm a patriot. But the bottom line is, if the number's bigger, I'm going to be happy.
Right. Okay. Yeah. And you and I both care about the well-being of the U.S. economy, no doubt. And thank you for that comment. The experience of recession, though, for investors is extremely minimal. Mm. That's what I want to say, because by the time we even realize that we're in one, when we go, oh, well, this stagflation thing is kind of real, and, slower growth, and, prices are not coming back down, and eggs or whatever else, we've been off to the races, right, with our holdings. So, people are feeling wealthier, right? And that's it's kind of a chicken and egg thing, right? No pun intended, where we feel wealthier, and guess what happens, right? We come out of the recession.
Mm-hmm.
Okay. So I'm not one to think of recession in the big, emphatic way that much of the national media thinks about it, because it's like this buzzword that, many of us think of 2008, okay, the Great Recession,
Mm-hmm.
okay, the 2009 period and so on, the Great Depression. may come to mind. I mean, there are certainly times in the history of this country that are worth avoiding again, no doubt. And Chris Gerber recently was on the program and alluded to the real risks that we have if we don't reorder global trade, if we don't reorder our own GDP, if we don't get our own fiscal house in order. And amen. For investors, though, I just want to point out that the experience of recession is minimal. The comeback from it is usually very fast. And so the mindset is, well, it was just kind of a blip on the map. Now we're into 2026 and oh, so what? Right? So I don't want to minimize it too much, but I do want to say, whether we have a mild one or we have a, not one, no recession, it really becomes pretty academic to the investor who is focused on what? Who is focused on funding their goals, right? That's what this program is setting out to do. Well, it's an equipping program to help listeners be wise and decide well. And the end to that is funding goals in the most effective way possible. So with that, I'll close, but I want to say it's been such a pleasure to be back with you, and really I'm grateful that we could spend this time together. I hope this has been beneficial to you and others you choose to share it with. From all of us at A Steward's View, we look forward to joining you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View with your host, Aaron Kolkman, Managing Partner of Fidare Advisors. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. While there, you can also enjoy the free Fusion platform for portfolio aggregation. Just click Fusion at the top of the page. To listen to this and other episodes of A Steward's View, visit the website Fidare Advice and click on A Steward's View podcast link at the top of the page. Fidare Advisors is a privately owned full-service life planning firm offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plans for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. Please consult the appropriate advisor. Fidare Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidare, please visit fidareadvice.com. That's FIDERE advice.com.